This report is for informational purposes only and does not constitute financial advice or an offer to buy or sell any securities. All investments carry risks, and investors should conduct their own due diligence.
Welcome to our deep dive into Kirkland's Inc., the familiar home decor retailer trading under the symbol KIRK. For years, Kirkland's has been a staple for affordable home furnishings, but today the company faces a critical juncture. In fact, their latest financial filings include a going concern warning, a serious red flag for investors. Let's start with the numbers. Looking at their recent performance, Kirkland's net sales have been on a consistent decline. In fiscal year 2024, sales dropped to $441.4 million, down from nearly $500 million just 2 years prior. And while their net loss narrowed slightly to $23.1 million FY 2024, it's still a significant deficit. This persistent unprofitability is why that going concern warning is so critical. It means there's substantial doubt about their ability to continue operations without major intervention. When we look at valuation, Kirkland's tells a stark story. Their price-to-earnings, or PE ratio, currently stands at 0. This isn't a good sign. It simply means they have negative earnings, making traditional PE calculations irrelevant. Compare this to profitable peers like Restoration Hardware at nearly 12 or Williams-Sonoma over 17. Kirkland's is clearly in a different league right now, highlighting the need for alternative metrics to assess its health. Now, let's talk about their capital structure and what this means for shareholders. Kirkland's is carrying significant debt, including $17 million owed directly to Beyond Inc., their strategic partner. This partnership, while crucial for survival, comes with a major catch for existing investors. Beyond Inc. has the right to convert debt into equity, potentially acquiring up to 65% of Kirkland's stock. This would mean substantial dilution for current shareholders. Furthermore, Kirkland's hasn't paid dividends since 2015, and there's been no share repurchase activity in the last 2 fiscal years. Their projected free cash flow for 2026 is also negative, estimated at -$7 million. This all points to a company in capital preservation mode, prioritizing survival over shareholder returns. Kirkland's operates in a cutthroat home decor market. With just $441 million in annual revenue, they are a tiny fish in a very big pond. To put that in perspective, Wayfair's revenue is over $14 billion. This scale disadvantage is a huge challenge, limiting their ability to compete on price or invest heavily in technology and marketing. While Kirkland's has an established brand and diverse products, their weaknesses are glaring. A significant decline in e-commerce sales, sensitivity to discretionary spending, and a heavy reliance on Chinese suppliers, which exposes them to tariff risks. The broader economy isn't doing Kirkland's any favors. Inflation, even at around 3%, continues to erode consumer purchasing power, pushing spending away from discretionary items like home decor. The housing market remains sluggish due to elevated interest rates, directly impacting sales of big-ticket furnishings. While anticipated rate cuts in late 2025 could offer a glimmer of hope, the immediate future is tough. And let's not forget tariffs. Current rates on imports, particularly from China, could cost Kirkland's millions annually, squeezing already thin margins. This brings us to the linchpin of Kirkland's survival, the strategic partnership with Beyond Inc. This isn't just a collaboration, it's a lifeline. Beyond has injected capital and expanded credit, but more importantly, they're helping Kirkland's transform its store footprint. We're talking about converting some Kirkland's locations into Bed Bath & Beyond Home or Overstock stores, with projections that these converted stores could generate double the revenue. The Kirkland's brand itself will become a private label for Beyond's new Bed Bath & Beyond stores, reaching new customers. However, as we discussed, this comes with the significant risk of Beyond Inc. becoming the majority owner through debt-to-equity conversions. It's a strategic gamble, a necessary move for survival, but one that fundamentally reshapes Kirkland's future. So what do analysts think? Sentiment is mixed. While a consensus of analysts rates Kirkland's a buy, price targets vary wildly from just over $1 to nearly $15. This wide range reflects the high uncertainty surrounding the company. They're betting on the turnaround but acknowledge the significant risks. In conclusion, Kirkland's is in the midst of a deep and challenging transformation. The going concern, warning, and persistent losses highlight the severity of their situation. The Beyond Inc. partnership is a critical lifeline, offering a path to revitalization, but with substantial dilution risks. Macroeconomic headwinds will continue to pressure consumer spending. For these reasons, our recommendation for Kirkland's is a hold. If you're an existing investor, closely monitor their quarterly reports, especially e-commerce performance, gross margins, and the success of those store conversions. For potential investors, this is a highly speculative play. It's advisable to wait for clearer signs of consistent operational improvement and financial stability before considering a position. The future of Kirkland's hinges on its ability to execute this ambitious turnaround. Will they succeed in leveraging the Beyond partnership to navigate these turbulent waters? Only time will tell. If you found this analysis helpful, please like this video, subscribe to our channel for more investment insights, and let us know your thoughts on Kirkland's in the comments below.